Welcome back to the Noob Selling Options channel, everyone. Seriously, I am absolutely thrilled to have you all here today. Listen, if you're intensely focused on reaching that specific $888,888 wealth milestone by 2032, you know we've got to rely on hard math, not just market hype. Today, we're putting together a comprehensive explainer on one of the most talked about events of the entire week, Apple's massive fiscal Q2 2026 earnings report. We're going to look at the spectacular headline numbers, dig into some pretty serious behind-the-scenes bombshells, and then we're going to run a ruthless valuation reality check. Because, in the world of options selling, understanding the true underlying value of a stock, that is absolutely everything.
And that brings us right to the core problem we're tackling today. Now, you might be wondering, Apple is undeniably an amazing company, but are we actually buying shares outright at this price? It's a really critical distinction we have to make. Having a phenomenal product ecosystem and a literal mountain of cash doesn't automatically equal a smart buy and hold investment at any valuation. So our goal today is to strip away all the emotion, look strictly at the data from yesterday's earnings call, and figure out if this amazing mega cap is actually worth its current, honestly rather hefty price tag. Or maybe there's a much smarter, mathematically sound way for us to play it.
Section 1. The Q2 earnings bombshells.
Okay, let's dive into this. Boom, $111.2 billion. That is Apple's top-line revenue for fiscal Q2. It sets an absolute March quarter record and surged 17% year over year. I mean, they completely eclipsed the $108.9 billion estimate. And what's driving this massive number? It's the iPhone 17 supercycle. iPhone revenue alone surged 21.7% to a staggering $57 billion. Management actually used the phrase off the charts to describe the demand on the call. They noted it's officially their most popular smartphone lineup in history. When you see numbers like this, you immediately understand the sheer gravitational pull of the whole Apple ecosystem.
And that top-line success cascaded beautifully right down to the bottom line. Apple delivered an EPS of $2.01. That's a 22% year-over-year jump, easily beating the forecasted $1.93. But want to know the real unsung hero making this happen? The services sector. Services hit yet another all-time high of $31 billion. That's up 16.3% from the previous year. This brilliantly illustrates how Apple isn't just selling you a piece of hardware, they're successfully monetizing that hardware month after month, creating an incredibly reliable, high-margin cash cow that just completely stabilizes their entire balance sheet.
And just to cap off all that good news, Apple rewarded shareholders with this absolutely colossal figure, a $100 billion share repurchase authorization. On top of that, they raised their dividend by 4% to 27 cents per share. This is the financial muscle of Apple on full display right here. By actively shrinking the pool of outstanding shares, they are artificially boosting their future earnings per share. It's a massive lever they can pull to keep institutional investors happy. So up to this point, the financial picture looks absolutely perfect. But as option sellers, we know there's always more to the story, right?
Section 2. Headwinds and missing guidance.
All right, let's shift gears a bit and look at the cracks in the armor. Because despite those massive earnings beats, some pretty significant bombshells dropped during the call that dramatically shift the narrative. These are the headwinds that every serious investor needs to price in immediately. First up, Tim Cook is officially stepping down as CEO on September 1, 2026, to become executive chairman. He's handing the reins to 25-year veteran John Ternus. That is a massive leadership transition for the world's most scrutinized company. Furthermore, Apple is really feeling the squeeze of the broader AI boom. They explicitly cited TSMC 3nm chip constraints, caused by intense competition for AI chip production, which actually capped their iPhone revenue. Cook also warned of, quote, significantly higher memory costs heading into Q3, because heavyweights like OpenAI, Google, and Microsoft are basically vacuuming up the world's memory supply. And finally, a big structural shift. Apple is abandoning its long-held, quote, net cash neutral goal. The game is changing, folks, and their supply chain is definitely under pressure.
Adding to all that uncertainty is Apple's notorious policy of keeping their lips tightly sealed. They provided zero multi-year guidance, focusing strictly on directional color for the immediate June quarter.
So Wall Street basically has to project the numbers themselves, and the consensus for the next 3 years is low double-digit EPS growth, around 10 to 12%, and mid-single-digit revenue growth of just 5% to 7%. The drivers there are the services expansion, those huge buybacks we just talked about, and steady AI hardware upgrades. But let's be crystal clear here, the market is pricing in steady, compounding growth.
We are not looking at explosive exponential multipliers, so do me a favor and keep that 5% to 7% revenue growth figure in your head, because it is about to become very important.
Now, what's really interesting about this next part, Section 3, the Peter Lynch PEG test. Let's take everything we just learned and run it through a mathematical framework. Look, we know Peter Lynch's strict 1980 standard of a 1.0 PEG ratio doesn't really apply to modern megacaps. So let's step away from the hype and be generous. If we assign Apple a wide moat premium, a PEG of 2.0, which is double the strict standard, just acknowledging their unshakable advantages, the fair value price sits at just $128.94. Okay, let's bump it up to a safe haven premium of 2.5, pricing in their defensive monopoly status. That still only gets us to $161.17. What if we go absolutely ultra generous? A PEG of 3.0, which borders on overvalued for almost anyone, but let's say it accounts for those multi-billion-dollar buybacks inflating the EPS. Even at that exceptionally generous premium, the fair value price is only $193.41.
And here is the absolute reality check. To justify Apple's current trading price of around $276 a share, the market is assigning it a massive, incredibly inefficient PEG ratio of roughly 4.2. That is a P/E near 34.2. Just think about that for a second. We just established that their revenue is projected to grow at roughly 5% to 7%. Paying a 4.2 PEG for a company with mid-single-digit growth and an AI supply chain squeeze, it's just mathematically inefficient, especially when you are aggressively targeting our $888,888 wealth milestone by 2032. And this brilliantly illustrates the difference between Apple and the high-conviction core holdings of an AI fortress portfolio. Companies like NVIDIA, Microsoft, and Broadcom, they also carry very high multiples. But the absolutely crucial distinction is that those premiums are supported by explosive, double-digit forward earnings growth. They actually have the underlying engines running at maximum capacity to justify the price. Apple, sitting at a 4.2 PEG, is quite simply priced for absolute perfection, but it currently lacks the explosive underlying growth engine to match those AI leaders.
Section 4, great company, rich valuation.
So let's bring this all together. What is the core takeaway for us here at Noob Selling Options? Honestly, it comes down to separating the quality of the business from the reality of the math. We have an amazing company sitting at a remarkably rich valuation. So our action plan is crystal clear. We are absolutely not buying shares outright at these levels. Purchasing shares at a 4.2 PEG offers an incredibly tight margin of safety. Interestingly, despite the massive earnings beat we talked about at the start, Apple stock actually saw a very muted reaction in after-hours trading, hovering right around plus 0.4%. Why? Well, because the market is already weighing that strong cash flow against those looming memory cost margin pressures. But for us, that is fantastic news. This muted price action points to a classic post-earnings implied volatility crush without an explosive directional move. That makes Apple a prime, excellent low volatility underlying for running the wheel strategy or deploying structured bull put spreads. We can collect premiums safely while keeping our short strikes far, far out of the money. I'll leave you with this final provocative thought. Is paying a 4.2 PEG ratio for single-digit growth a mathematical reality you really want to bet your hard-earned capital on? If you want to hit that 888 milestone, you have got to be disciplined. You have to sell premium where the math favors you, rather than blindly buying into overextended valuations. Listen, if this explainer helped bring some clarity to your strategy, please smash that like button and make absolutely sure you subscribe to the Noob Selling Options channel so you never miss our structured, math-driven breakdowns. Until next time, stay focused, stay disciplined, and happy trading.